Welcome to the Loan Witch End podcast. This is episode 2 of 2 in a investment money series. We are talking today about financing for investment properties. So if you listen to us in episode 1 or you go back and listen after you listen to this one, we talked about flipping versus buying and holding. So you're a new investor, you want to know which one might be right for me. We talked about that in episode 1. We are here with Scott Roberts. Scott is a very seasoned mortgage financing professional. He does hard money, well, private money, we want to say. We're going to actually talk about that in this episode, the difference. Scott is the ultimate expert. Dozens of years that he's been in the financing of real estate world. So Scott, welcome.
Thank you, Jen. It's a pleasure to be with you.
Thanks for being here today. Okay. So in continuance of episode 1, where we talked about investment property just getting started,
right.
They're going to need to pay for it. So there's 2 real ways in the investment world that I see, correct me if I'm wrong. Mm-hmm. You've got conventional financing, which is just the mainstream. That's the stuff that I do, which is, you know, just the 30-year fixed, lower interest rate. That's not for everybody. It doesn't always serve a purpose.
Correct. Yep.
And then there's private financing. So think of them as just 2 lanes on the highway. We're going to talk about the private one first, because that's your wheelhouse. So enlighten us.
Okay. Well, again, I'm a private money lender, which means I take my own money and lend it to real estate investors who are either going to buy a house to make into a rental,
okay,
or they're going to do a flip, which is fix up the house and sell it down the road. So I finance both of those types of things. Maybe for some clarity, so I'm sort of a private guy, private lender. There's also what's out in the marketplace, something called hard money. And so what's the difference? Well, usually hard money is done by a firm, and there's a number of them in town. Mm-hmm. That do hard money. There's like a jet lending, there's longhorn lending. So, and I think that oftentimes those are a good source for beginning investors. For mm-hmm. If you want to get your first investment property loan, it's going to be expensive. It's not cheap, but they're very helpful. Oftentimes they'll do an evaluation of the property for you for free. So that's hard money. Private money is when you come to someone like me or other people who get to know you. Maybe they have experience, or maybe they don't sometimes. And they lend you their own money. Sometimes they lend you cash from their checking account. Other times they can lend you their IRA. And that's kind of a whole other way of financing. And we can talk about that more if you like.
So, well, let's go to hard money first. Yep. So in private, there's a couple of different categories, buckets. You mentioned hard money.
Yep.
Usually these are lending institutions.
Correct.
Where they probably have investors behind the scenes, of course.
Yep.
But they're going to go out and you come to them with a project. Actually, I want to get into a little nitty-gritty on that.
Sure.
Usually, I know I hear ARV a lot, of after repair value. They're really loaning on what they perceive or calculate through their investigation to be after repair value, right?
That is correct.
So, for example, let's say I'm purchasing a property for $100,000. Doesn't matter the method in which I'm purchasing.
Yep.
We're purchasing it for $100,000,
yep, and
I'm going to put $30,000 into it.
Okay.
Well, I'm like, oh, it'll take $30,000 to bring it up. They're obviously going to check my numbers.
That's
what
right.
I think is $30,000 and what they perceive it to be. So let's say I go to one of these hard money people in my local area,
yep,
and I say, hey, I'm all in it for $130,000. Is it right that they're going to want to make sure that it usually is below a 70% after repair value? Is that how they underwrite it?
Usually what they'll do is they'll take 70% of the after repair value,
okay,
and subtract from that number the amount of the rehab.
Okay.
And then they'll say, this is the number that we're going to give you.
Okay, to purchase the property.
That's right. Oftentimes they will loan you the money to rehab it, okay? But they'll do that in increments.
Okay, like draws.
Like draws,
mm-hmm,
exactly right. But so your contractors have to do the work is finished, The hard money lender comes out, looks at the work. Is it done? Is it done right? Is it actually completed? Yes, it is. Signs off, and then your contractor gets paid on that particular portion.
It sounds so easy.
I
know there's a lot of in between there, but
yeah.
The hard money lenders, they churn through, at least the ones that I know, they churn through a lot of these. Not every proposal is accepted. I'm sure if we had them here. But they are really, well, they're, like you said, helping do the diligence because obviously they don't want to be upside down either.
No, they don't. And they're pretty savvy. They won't be upside down.
Yeah.
And the key is, getting back to what we were mentioning before, is have you evaluated the property correctly? Is the ARV for the investor, have you really nailed that and got it down? Because if you haven't, and you're kind of hopeful up here, but the real value is down here, the lender is going to see that.
Yeah.
And the profit can get eroded very, very quickly if you have estimated your value wrong.
Something that I hear, because I hear the other end of it. Usually, if people are going to buy and hold, they'll purchase and rehab under hard money. And then someone like me that's more conventional financing, we will come in and refinance it after the fact to the nice, pretty 30-year fixed.
Sure.
No prepayment penalty, et cetera, et cetera. But sometimes I'll mention to clients, hey, you really sounds like you'd be good fit for a hard money loan to acquire that property because it's an ugly property. It needs tons of work. It would never go through the test that I have.
Yep.
And the first reaction sometimes people have is, oh no, hard money, it's so expensive. But my response to that is, maybe not. Like when you work all those costs in it, I mean, hard money is really only meant to be for what, like 90 days?
Well, yeah, maybe 90 days, 6 months.
Max. And even though the rates are high and there's some costs up front, I'm sure.
Right.
When you work that all in, and if you've acquired a property at the right price, and you're rehabbing it, and the after repair value is XYZ amount, it's all in the analysis. It could be totally worth it if the numbers work.
Exactly right. And when you think about it, people say, oh, that's so expensive. Well, do you use a credit card? That's expensive.
Yeah.
Okay. And people say, well, if you charge 12%, let's say, that's so much money. Well, it's for less than a year.
Yeah.
So you're not paying for a full year worth of interest. And if you are, you've probably got a problem with the rehab.
Yeah.
So, it's a much shorter period of time. And you should be buying it at a level where the interest rate that you're paying should have nothing to do with the ultimate value that you're creating.
Yeah.
And if it does, you're going to have some problems.
Yeah. Yeah, it's just a vehicle.
Yeah.
So that's hard money. And then, by the way, hard money usually, unless you're going to flip, if you're going to flip it, you're just going to flip out of the hard money loan. You're going to sell it.
Yes, correct.
If you're going to buy and hold and rent long term, we talked about that in episode 1. You would come to someone like me. You definitely want to refinance out of the hard money loan.
Yep.
And you would refinance with someone like me. So how do people get to the private lenders? Like, when would they go with someone like you, who's a private lender, versus that hard money?
A couple things. One is they would probably meet me in my travels and their travels, because we go to events and things
Similar
like that.
events,
yes.
Yeah.
And they would come to someone like me because we don't charge what they call junk fees the way that a hard money lender would charge. What is that? Well, they charge things like an underwriting fee. They charge points. We do too, but they probably charge more points than we would charge. They charge processing fees. They charge, if there is a draw for rehab construction, every time their person goes out to view the property, they're going to charge for that, maybe $200, maybe $300. I don't do that.
Okay.
So my costs are less.
Then why wouldn't everybody be doing that?
Because I might not take somebody that a jet lending would take.
Yeah.
Probably,
They're more transactional and you're more longevity relational.
That's right.
You want to have a relationship with this person to help them in their investment journey become a multiple.
That's right. I don't want to have to foreclose on them and take their property.
Yeah.
I want to see that it's my money, it's coming out of my checking account. So I want to see that they have a good business plan, they have some experience, or if they don't have experience, they have someone on their team that does.
Yeah.
I want to know that they can refinance with you when they're done with me, assuming they're doing a rental property. So how do I know that? Well, I have to qualify them like you would qualify.
Yeah.
You know, so that's why they might come to me, and you know, rather than as I say,
another company.
Yeah,
more institutional.
It costs a little bit less.
Okay.
We have some more flexibility too. You know, we're not as maybe strict in our process as a hard money lender would be.
Well, and we haven't even covered in this episode all of the ins and outs of private lending.
Correct.
I mean, there really are other avenues and divots. We're just on the tip of the iceberg. We would be here all day talking about
absolutely.
But I think the important thing to know is if you are getting into investing by educating yourself. We mentioned in the prior episode, we'll mention it again, Bigger Pockets is actually a good place to start.
Great
It's kind of a podcast. They've got a book, lots of good information. And then in your local market, getting to know people and by networking and talking, and that's how people meet you, is through networking. I met you through networking.
Yeah.
And so, you know, listening to podcasts, listening to radio shows, what they're called podcasts now, but doing that, you're going to start evolving. But for that first or second property, and just understanding, hard money is probably going to be, you know, or conventional. If it doesn't need fixing up, you might not need hard money.
Right.
You know, if you can get right into a conventional loan, like with someone like me, it's just a conventional loan.
Yep.
Bam, purchase it, start renting it out right away, and you're ready to go. So
exactly right.
Well, thank you for shedding some light on a really great topic. There's a lot of other topics that can come from this. So we want to hear your comments and questions so that we can make more episodes. So let us hear that. We'll put Scott's info down below and a couple of the resources we mentioned. Thank you for tuning in to another video, aka podcast. We'll talk to you soon.